Well, for more on the market now, let's bring in Capital Area Planning Group Managing Partner and CNBC contributor Malcolm Ethridge. Malcolm, happy Friday. Well, let's step back. The S&P, again, hasn't closed at highs like this every day since November 2021, which is just before the index peaked and took years to recover. Are these highs, combined with the meme-ish mood, a good sign or a bad one?
Well, I think it's probably a good sign that the meme-ish mood hasn't gotten as out of control as 2021, right? If you just look at the volume in a lot of those names you guys had up on the screen earlier, it's not nearly as close to what we saw in GameStop and AMC and a couple other names that got sprinkled in. For one thing, it is a little bit spread out, the bets that folks are making, trying to hit that home run. But I also don't think that there's enough staying power in this meme mood, because what we're seeing in my estimation is investors who have done really well since Liberation Day in tech stocks, taking those gains and then looking for another place to park those gains for a little while the market is at all-time highs, like you just said. So I think what we're going to see is a return back to retail's favorite names, the NVIDIAs, the Teslas, names like that, about a month from now, where those meme stocks will cool off and we won't be talking about meme mania the same way we did in 21.
Well, even those favorite names are pretty hot. What does a balanced portfolio mean right now in 2025 with the indices where they are? And what's the alternative to selling stocks and going to cash if you're queasy about these highs? Because trying to time the market usually does not end well.
Yeah, John, it's almost a curse word right now talking about a balanced portfolio or diversification. Folks just don't want to hear it because the market is doing so well. And right now, everything is consistently going up and to the right. But I think to your point, this is a great time if you were a person who was extremely concerned back in March, April, saying things like, I don't like the way the market looks and I'm considering getting out. I think I might need to sell something. I think I might need to make a move. You're being given an opportunity to exit before things actually start to get choppy. And the trade scenarios aren't all solved, right? We were talking about 90 trade deals in 90 days or something like that. So the pause that's about to come undone in the next couple of weeks here might return us to a place where investors start to get worried again and you see that trade coming back down. So I think anybody who is riding high right now, feeling great about the gains they're seeing in their portfolio, but just 4 months ago was extremely concerned about where do we go from here because the market had fallen almost a perfect 20%. I think this is the gift that allows you a space to be getting out.
So correct me if I'm wrong here, but I think if at the end of last year, as an investor, you had taken some off the table of your domestic stock exposure and said, hey, I'm going to buy international stocks instead, you might actually be doing better, and not all of it off the table, but some. You might actually be doing better than the general, like S&P, even though the S&P has been doing great. So are international stocks, even international ETFs, still a decent bet at this point, valuation-wise, based on what we see happening in trade and other economies?
Yes, and I think you could even take the same trend that we're seeing here in the U.S., where for the first couple of years following ChatGPT's release, American tech companies were dominating with their large language models and what they were able to create. And then you saw with DeepSeek back in January, with open source models, companies were able to create a lot more that allowed developers to do a lot with a little. And I think that theme is carrying through parts of the EU. It's carrying through parts of Latin America, even, and also some of the Asian countries. So I think being invested internationally in tech specifically is a great place to be because it's unlikely that the U.S. continues its dominance in that space with the AI trade. However, we know that the AI trade has to continue to go because you have companies like a Meta, for example, who's investing $80 billion a year, or Microsoft $80 billion a year. We just heard from Alphabet that they're increasing their CapEx spend by $10 billion. So that definitely means that this trade is going to continue for some time.
Looking at some emerging Asia type funds, China used to be the not just the tail that wags the dog, but maybe the whole dog with those kinds of funds, but doing pretty well actually right now. Can investors think of that as perhaps a place to put some money, emerging Asia around that whole region to diversify away from high valuation U.S. exposure?
I wouldn't consider it an investment like you just said. I wouldn't consider it a place to put money longer term that you're expecting to see, a reasonable amount of volatility. If this is speculation, then yes, by all means. China is still one of those places that we just never know whether we can trust the data that we're getting. We as American investors are legally not even allowed to invest directly in Chinese companies. And so with all of those dynamics underpinning ETFs and everything else that give you exposure to China, it's a great place to place a few trades just to see what happens. But it's not necessarily a great place to be allocating a meaningful amount of the dollars that you're going to need to rely on in retirement, say, for example.